Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning breakfast, coffee or tea, and let's enjoy today's episode.
Okay, so have you been watching the economic news lately? Maybe, like me, watching those mortgage rates just keep ticking up and up, feeling that idea of buying a home maybe slip a bit further away, and then boom, almost out of nowhere they drop sharply. Makes you wonder, what on earth just happened there? It's definitely a question a lot of people are asking today, especially if you're anywhere near the housing market right now. So let's unpack this. Let's really get into it. We're doing a deep dive today into this brand new Zillow research report. It's literally just out today, September 10th, 2025, by Carr and Nang. And it flags a really significant and honestly quite surprising shift in mortgage rates. This could really send ripples through the whole housing market. It doesn't feel like just a tiny blip, you know? It might actually signal a real turning point.
Yeah, it's fascinating, isn't it? Just watching how quickly some key economic data can, echo through the financial markets and hit you directly, especially with something as big as buying a home. So our mission today really is to pull out the most important nuggets from this report. It's super timely. We want to help you understand not just what made rates suddenly change course, but also why it matters for how you look at the housing landscape from here on out. We'll dig into the triggers, the immediate causes, but also the bigger market picture and what this unexpected twist might mean for you, whether you're thinking about buying, selling, or maybe just keeping tabs on your home's value.
That's a huge question, absolutely. And to get there, we really need to look at what actually set off this sudden U-turn in rates. So let's jump right in. The main finding: mortgage rates dropped sharply, which for a lot of us feels pretty surprising, right? Given the trend we'd kind of gotten used to, it almost felt like we were locked into this upward path. But the timing, that's what really makes you look closer. It wasn't just random. It happened like immediately after the Bureau of Labor Statistics released its August employment report. That was September 5th. So it was a direct reaction, almost instantaneous, to that one specific piece of news.
It's exactly. That BLS report was definitely the catalyst. Carr and Nang's analysis really zooms in on specific things in that report that were, quite revealing. They signaled a clear shift in the labor market. First off, job growth itself slowed significantly. And this wasn't just a little slowdown, it was a noticeable downshift from recent months. But here's what adds another layer of concern. The job gains from previous months, they were actually revised downward. So it's not just about August looking weaker. It suggests the recent past wasn't quite as strong as we thought either. That kind of paints a picture of maybe a shakier economy than we realized. And maybe the most critical part, the unemployment rate looked relatively stable, but only because people actually left the workforce. It wasn't because lots of new jobs were being created. That kind of stability, it doesn't really suggest underlying strength, does it? It points more towards weakening participation, maybe hiding a lack of really solid opportunities.
Right.
So if we connect this to the bigger picture,
these specific indicators, the slower job growth, those downward revisions, the reason for the stable unemployment rate, they directly fed into what investors were thinking. The market basically started betting pretty strongly that the Federal Reserve would have to, cut interest rates aggressively in the coming months to support the economy.
Mm-hmm.
That expectation, that kind of forward-looking guess about what the Fed might do next, that's precisely what pushed mortgage rates down. That's a classic example, really, how market expectations about future policy can have a huge immediate impact on borrowing costs right now.
Okay, hold on. So this immediate sharp drop, that sounds like amazing news for buyers, right? Finally, some relief. But the Zillow report, it adds this layer of, let's call it caution. It suggests maybe we shouldn't expect this low rate party to last forever. What Carr and Nang points out is that even with this recent drop, Zillow still maintains its expectation that mortgage rates will end the year near the mid 6% range. That feels contradictory. A big drop now, but still ending up back in the mid 6s. What's behind that? Are they seeing something the rest of the market missed in that initial reaction?
That's a really critical distinction, you're right. Separating that immediate market reaction from the longer-term forecast, Zillow's projection seems to suggest that, yes, the market reacted strongly to that weak jobs report anticipating Fed cuts, but maybe there's still some underlying economic resilience or perhaps, persistent inflation worries that will likely prevent rates from just plummeting and staying down. They're probably factoring in other things too, global factors, energy prices, just the ongoing supply and demand stuff in housing itself, things that aren't solely driven by 1 month's jobs numbers. So while that single data point yanked rates down, the bigger economic currents dictating those longer-term trends, maybe they haven't shifted enough for Zillow to completely change their year-end view. It's a good reminder, isn't it? One data point, even a dramatic one, rarely tells a whole story for the long haul.
That's such a crucial point for anyone trying to budget or plan. So, okay, rates drop a bit, but it's not like a magic wand fixing everything for everyone. Which brings us nicely to the more complicated reality of how this is actually hitting the housing market itself beyond just the rate number. Because even with this modest rate relief, as the report calls it, Zillow is crystal clear. Affordability remains a major hurdle for home buyers. So it's definitely not as simple as rates dropped, problem solved. There's still this deeper dynamic making it tough for a lot of people to get into the market.
Absolutely. The report paints this picture of a really interesting, almost conflicted dynamic between sellers and buyers right now. Zillow's research highlights that more sellers have come off the sidelines, particularly in the first half of this year, which suggests maybe that lock-in effect, people feeling stuck with their super low old mortgage rate, maybe that's starting to weaken a bit. Perhaps life changes are just forcing moves, or sellers are finally adjusting to the reality of higher rates being the norm now. However, and this is the really critical part, the buyer pool has not kept pace. So even though more homes are listed, the number of people actively out there ready and able to buy hasn't grown nearly as much. That creates an imbalance, doesn't it? And the direct result of that mismatch, more homes for sale, but not a proportional jump in buyers, is exactly what the report says, a high number of listings and price cuts. It really raises that important question. If rates tick down even a little, why aren't more buyers flooding back in?
It is a crucial question, and it really underlines that contradiction we were just talking about. A rate drop, while definitely welcome, it doesn't automatically fix the market for every single person out there. That affordability crisis is still very, very real. It's driven by a mix of things. Home prices are still high, let's be honest, plus the bigger economic picture. Even if rates dip slightly, for many people, that monthly payment on today's prices, it's still a huge stretch. So, yeah, we might see more homes listed, maybe even more price cuts, but that dream of owning a home still feels out of reach for a big chunk of potential buyers. It's like the market threw a bit of a party, but only certain people could actually afford the ticket to get in.
That's a great way to put it. But, this very complexity, this sort of unevenness, it also creates some interesting, maybe unexpected openings, which kind of shifts our focus to a slightly more optimistic angle, but for a specific group. What Zillow's analysis points out is that for those buyers who can navigate today's affordability constraints, the market has actually become more favorable. That's the key distinction, right? It's not suddenly easy street for everyone, but it's a strategic advantage for people who are financially positioned to act right now. It's become a different kind of market, maybe one that rewards being prepared and ready. And the Zillow report lists specific advantages for these buyers. First, they're facing less competition. That's a huge change from the crazy bidding wars we saw not long ago. Instead of, fighting 10 other offers, they might have more breathing room, more time to think. Tied to that, there's more inventory. More homes on the market means more choice. Buyers can be a bit pickier, maybe find something that truly fits what they need instead of just grabbing whatever they can get. And finally, maybe most importantly, they have greater negotiating power. This could mean getting a better price, sure, but also maybe asking for repairs or getting contingencies accepted, things that were almost impossible in the peak sellers market a year or two back. It's not a complete free-for-all anymore. Buyers can actually negotiate again.
That's a fantastic point. And this shift, it's not just a feeling, right? The report uses Zillow's own data to back this up. Their market heat index is showing more and more major metro areas are shifting into neutral or buyer's market territory. That's a pretty powerful signal. It's moving beyond just stories from individual buyers and showing a broader trend across major cities. It's not just a hunch, it's actually in the numbers. And the significance of that shift, you really can't overstate it. Zillow's data points towards a clear break from the seller-dominated markets of recent years. For so long, it just felt like sellers held all the cards, didn't it? Homes selling in hours, often way over asking. Now we're seeing this recalibration, a return to something maybe more balanced, or even, like you said, tilting towards buyers in some places. So what this big shift could mean for your strategy, if you're thinking about buying, it's huge. If you are one of those buyers who can handle the current affordability situation, maybe now is the time to re-engage, knowing you might have more options and definitely more leverage than you would have had before. It's about being smart in this changing game.
Exactly.
So tying it all together, what's really fascinating here is this complex chain reaction we've traced. You have this sharp mortgage rate drop, kicked off by a weaker jobs report, and investors betting on the Fed easing up. but it creates this really nuanced housing market. On one hand, affordability overall, still a major challenge for many, no doubt about it. But on the other hand, these shifting dynamics are absolutely creating specific opportunities for buyers who are strategic and prepared. It's not a market where everyone wins equally, but it's a market that seems to be rewarding those who are informed and ready to move when their conditions are right.
Couldn't agree more. This deep dive really highlights how fast things can change in the economy and the, well, sometimes really unexpected ways those changes hit big life decisions like buying a home. The market is definitely breaking from its recent patterns, that seems clear. It's presenting both ongoing hurdles and these newly emerging advantages. The whole landscape of homeownership feels like it's evolving right in front of us. And so, maybe the question we leave you with is this. Given that Zillow still thinks rates will likely end the year back in the mid 6% range, despite this recent sharp dip, how might this sort of tug of war between the immediate news driving rates down and those longer-term forecasts pulling them back up, how might that continue to shape your decisions? Or just your outlook on owning a home in the future? What signals are you going to be watching in the months ahead? Well, thank you for joining us on this deep dive today. We really hope this analysis helps you make sense of the, let's call it exciting and definitely ever-changing housing market. We'll catch you next time.
Well, that wraps up today's episode of Reality Reports, where real estate meets real life. For more updates, tools, and insights that will help you buy, rent, or invest with confidence, be sure to follow, subscribe, stay connected, stay informed, and stay ready. Until next time.